Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. Alphabet and Microsoft both had disappointing earnings today, but it wasn't a substantial move, downward move, rather in the markets. So going to be interested to hear Rob's insight on that. And as always, going to be interested to hear everyone's questions and comments. All right, if you've attended any of our live sessions previously, then you've seen this. But if not, the main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available to be read in full detail on our website, or feel free to take a screenshot if you like, but that's the main point to take away. So for this session, as you'll see circled on the screen, there's actually only one method for asking questions, and that's going to be through the Q&A window. We are live streaming to multiple different platforms right now, with that being Twitter, Facebook, YouTube, and of course our Zoom audience. So we have a limited question portion towards the end of the session, and we'll try to get through as many as we can. After Rob goes through a general presentation and looks for some case study considerations, he opens it up to a few questions. So again, there are time constraints for this session. So if we don't get to your question, just know it has nothing to do with the validity. We just only have so much time. Also, take that as encouragement to attend the insiders meeting when there's a 45-minute session solely based on answering questions from subscribers. So obviously a much higher likelihood of getting your question addressed there. Lastly, we have the chat window as well. Any support related queries I can handle in there, or for any interaction amongst other attendees, please feel encouraged to use that window. Just make note that at the bottom, it defaults to host and panelists. So if you would like everyone on the webinar to see your message, be sure to change the to from host and panelists to everyone, and that will make it visible. All right, I will stop rambling on about the housekeeping details and introduce the man of the hour that we're all here for. That's Rob Roy.
Hi, everyone. Thanks, Zach. And welcome to this session. I'm trying to share my screen here and get that moved over. There we go. Thanks, Zach. Appreciate it. All right. Thanks, everybody. As you're going to see in a minute, I am up in the mountains and kind of drowning the sorrows a bit from the weekend golf tournament. Many of you were aware of playing in the tournament and wish me well. Fortunately, it took more than well-wishing to cover off the tournament. So 46th out of 240 was where the final was. Not exactly a top 10. Not horrible either, but that's kind of the way things go in the world of golf some days. Sometimes it's just not your weekend, but very respectable at least. So now we'll go ahead and move into the more important things. So I want to share with you the way the TradeFinder works. As Zach mentioned, we do a Q&A at the end, but before we get there, we'll talk about the markets, not just the US market, but the international markets as well. We'll go through and look at a closed trade alert, if there was one for this week, for our alert subscribers at ewotrader.com. Talk about the differences between that and the case study considerations that we do at TradeFinder as we get into the process of the presentation. Sorry about that. Animals going crazy up in the mountains. And we'll go through and review the recent case study considerations, and we'll look for one tonight, and then we'll get into that general Q&A. So here's the video, and as you can see the background, if you're used to it, up in the mountains rather than back in the dragon capsule, as I call it. So let's go ahead and take a look at where we closed today.
Hi, Rob, I'm sure you might be aware, but we can't see your video or the screen at the moment.
Yep, back on the one screen, so that should be good now, right?
We can see your screen and the software, we just can't see your video.
No video?
There we go.
It says it's on. Oh, okay. That's weird. It showed it was on my side. I don't know that that's a big loss that you couldn't see the video, but there you go. All right, so here's the market, and this is what's interesting. So we moved to the downside today, as Zach mentioned in the intro. We had a couple negative earnings reports from two biggies, Microsoft and Google/Alphabet, and look at the volume. Really non-existent volume. We did move to the downside, but you can't really count that when the volume is that slight. So then you look at the moving averages and you can see that's what happened. Literally in one trading day, we hit the 50-day moving average on the high and the 10-day moving average on the low, closing on top of the 10-day moving average. So if the market looked negative today, it really wasn't. You can't consider that a negative day when you just bumped the 50-day moving average and stayed on top of the 10-day moving average on very low volume. Now, that could change tomorrow. Tomorrow we have Meta, and then Thursday we get Apple and Amazon. So a couple biggies on Thursday. And let's not forget, we still have the GDP to come out, as well as the Fed, which that's pretty much baked in the cake, I would think. 75 basis points. There was whispers earlier of 100 basis point. That's off the table now. At least the Federal Reserve has come out. At least some of the governors in their offshoot videos have said, no, we're not going to do that. And there's even been talk now, the whisper number is, would they only go 50 basis points? I don't think they're going to do either one of those. I think they're going to stay 75, which is what they've talked about. And so I don't think that's going to be much of a difference in the markets. I think the big thing is going to be the GDP report. But so many negative things have come out from the economy that if the GDP report is negative and it shows official recession, unless it's really negative, I don't think that's really much of a movement in the markets either. So what is going to drive the markets? What are we going to go from here? That's really a very interesting question. Earnings season, I think, is probably where we're going to go. For some reason, Microsoft and Google got forgiven today. Is it going to stay that way if we consistently go through? And the numbers, the top line numbers haven't been that bad. It's looking forward. The forward guidance has been where the big negative part has been, which would be expected, right? Because inflation's higher. We know that. You know, the Federal Reserve is raising rates. We know the economy is slowing. We know all of those things. So where's the market going to go? I really can't tell you. We're right in between. We had that 38.2% wave 4 correction. We had the 61.8% wave 5 extension. All that is classic Elliott wave Fibonacci. For those of you that are just joining us on one of the live streaming services, it doesn't get any more classic Elliott wave Fibonacci than that. And where are we? We're right in between. And so we've come up within a whisker of closing this gap. The second gap has already been closed. And now we have the 10, 30, and 50-day moving averages all converging together. Something's going to happen, but I have no idea which way we're going to go. You would have thought that today might have been a bit more negative with what the guidance was, the commentary on the earnings reports. But when you see volume like that, you don't even really count that it was a down day. And that's something that I would share with you. When you see volume this low, whatever happens in the trading day, I mean, if you have individual positions, you're like, well, that counts. Either made money or lost money in your individual position. But overall, for the market, when you have that low of volume, it is really immaterial as far as where we go from here. So perhaps we just have to get a little further into the earnings season. Between this week and next week, the majority of the S&P 500 will have reported. And so from there, we'll have a better idea of where the earnings are going to go. We'll get past the Federal Reserve. We'll get past the GDP. I don't know what could trigger the market if today had such a slight effect. It's going to be really interesting to see over the next couple of trading days as we get into Friday. Does anything move the market? Do we move into a trading range? That wouldn't be that surprising either, if this is the end of the wave 5. So let me qualify that. If this wave 5 is it, if the bottom is already in the market, going through a sideways consolidation, whether we move into a flat, whether we move into a triangle, a couple of zigzags, whatever, any of the corrective patterns moving back and forth between this 4 and 5, all that would be quite normal. However, if that it was just a bounce off the 61.8% fib level and we're going to make a lower low, then you would think at some point this week specifically, we would need to pick up with volume to the downside to go down and make that newer low. So the longer we stay sideways, or the longer we just drift a little bit lower on low volume, the greater chance there is that the bottom is in, and that we do tend to move to the upside. So I know that that may seem counterintuitive, knowing that what's going on in the economy, et cetera. We talked about in the weekend report, the last jobs report, initial jobless claims was higher than expected, the worst since November of last year. So if the job market is easing, which that's where everybody's been pointing to, that's the strength in the economy, is the fact that the job market is so good. But if we lose that, where do we go from here? But I will tell you that unless the downward move catches more volume, it's the exact same story that I was telling you on the upward move, that this upward move needs more volume to continue. It's the same story on the downward move. So if we stay in this low volume area, then we're going to go through some sort of a sideways consolidation. A couple of you actually asked questions about that on YouTube. And by the way, if you haven't visited our YouTube channel, please do so. Elliott Wave Options on YouTube. We post videos a couple times a week, usually. And we love to get your feedback, the interaction. I really like that. We've got a lot of you that comment each and every video that comes out, and it's great to share ideas back and forth. That's what the markets are, right? If everybody viewed the markets the same way, there'd be no market. You have to have differing views. There's a buy and sell on every position. There's a long and short on every position. So that's what makes markets. And then which one slightly outpaces the other determines the direction of whether we go up or down. But there's always a long and a short on every single position, or a buy and a sell. All right, so there isn't really much else to say on the S&P, other than the fact that we are dead between the 10 and the 50-day moving average, and we're going to break out of one of those probably in the next couple of trading days. Now, here's something that's really confounding the experts, is why in the world are rates going down, with the fact that the Federal Reserve is raising rates? They're about to bump another 75 basis points. I've opined about international money coming in, which it was for a while, but that has slowed significantly. So it's not that. Is money significantly coming out of the equities market and moving into the bond market? Well, we'll show that either, especially with this lower volume drift down today. So it doesn't seem to be at this point that either. Why are bonds moving to the downside? Is there going to be that kind of economic weakness? That's the only scary thing that could be involved there, is the fact that the bond market, and remember, if you're new, if you're watching on one of the social media services and you haven't been visiting with us before, I've talked about this numerous times, and this is one of those rules of trading. The bond market is very important. You don't have to be an expert in bonds to be a good equities trader, but it's my belief that you should have a good working knowledge of the bond market if you want to be a good equities trader, because the bond market is so big. It's larger than the equities market. There's a lot of really smart people in the bond market, and the equities market often takes its cues from the bond market. That's why we look at the TNX every single time. If you're wondering, why is he always looking at that? Because you have to look at something, whether you look at TNX, TVT, TLT, whatever you want to look at for the bond market, you need to get some sort of an idea of what's happening over there and create the correlations with the equities market. Otherwise, I don't think you'll be as successful as an equities trader, options trader, derivatives trader, whatever, as you could be if you did have a good working knowledge of the bond market. Now, the key here is we're at a pretty good area of support. Not so much from a fib level. 33% is really kind of in between. It's not really quite to the 38.2% level, but it is a support and resistance level, just from traditional support and resistance levels bouncing off this 27 level. But it's got a lot of really smart people scratching their head on why interest rates are going down when the Federal Reserve is embarked on this. Inflation, we know, is high. Is that the fly in the ointment? Is that the Black Swan? Is that giving us the tale that things are going to be worse than expected? We'll see. Or are they telling us that, and there's been speculation of this, I just don't believe it, but there has been. So I always try to present both sides because my opinion's meaningless, right? I share it with you, but it doesn't mean anything. It's just my opinion. But there are opinions out there that the Federal Reserve is going to go this time and then they're done. So they'll do the 75 basis points this week and then that's it. They're done raising rates. I don't see that. I think that they're going to overshoot. I think they're going to continue to raise rates until they really put the economy into worse than a light recession, which a lot of people are thinking this is going to be a really shallow recession. If I'm right and the Federal Reserve overshoots the mark, it's probably going to be worse than that. And then the Federal Reserve does an about face and they go from raising rates to lowering rates, potentially from one meeting to the next. It's happened in the past where they raise rates one meeting and they cut rates the next. I think that's the likely scenario that plays out here. But again, it's just my opinion. So that's the only thing that is being backed up by the TNX, at least at this point right now, in my opinion. Look at the dollar. Dollar found a little bit of support here. We had talked about this. I like the strong dollar. I didn't like it going vertically like this. And you've heard me say this numerous times. I don't like it when things go vertical because when they go vertically up, they often come vertically back down. It's exactly what happened with the dollar. So we retraced that vertical move. We've been consolidating, a little bounce back to the upside today. That's a positive sign as far as the economy, that maybe the economy isn't going to be that weak. So there's a little bit of conflict here between apparently what the bond market is showing us and what the currency market is showing us with the US dollar. Which one's going to play out when those things get out of whack? I talk about correlations in the market a lot, and most of the time the correlations stay in tune. Every now and then they get a little bit out of whack, discombobulated as I call it, but it doesn't last long. And then they get back into sync. And so one of those two is going to change and they'll be back in sync in the not too distant future. So the dollar is saying, hey, maybe the economy isn't that bad. This could be a shallow recession. But bonds are saying, maybe not. Maybe this is going to be a little bit worse, and we're looking forward towards the fact that the Federal Reserve may have to go to cutting rates sooner than people have thought. The expectation had been that the Federal Reserve would go through their rate hike campaign. They'd go 3 or 4 meetings with no rate hikes or cuts, just staying status quo, and then they would begin to cut. That was the initial perception, which would make sense if everything went as expected. My opinion comes from the fact that I think the Federal Reserve will overshoot the mark on raising rates, just as they overshot the mark on cutting rates from COVID, et cetera. So pretty interesting stuff there. And we'll see how that all plays out. All right, so let's take a look at some of our other markets. The diamonds, looking at the DIA, you can see that same type of scenario here, really close to filling the gap. Heading back to the downside there, breaking back below 320. So we came right up to this all important 320 level, turned back, headed back to the downside, right on top of the 50-day moving average here on the diamond. So slightly better price action on the Dow than on the S&P, where we bumped our head on the 50-day moving average on the SPY, kind of closed right on it. But look how close the 10 and the 50 are on the diamonds. They're a little bit closer than they are on the SPY. So you could say that it's about the same. But here we are with that 10, 30, and 50-day moving averages all converging together, again, telling us that something is likely to happen. So when you see that, when you see them all converge, are we likely to break out sooner? Or are we likely to move into a trading range? Well, that's where we bring in the DMI and take a look at that. And so we look at the ADX, and when the ADX dives below 15, and more specifically 13, you're closer to a breakout move in the markets than to a sideways move. So if the ADX had been back up around 20 or so, say back where it was here in mid-July, be thinking that, hey, we're probably going sideways for a while. Just exactly what happened when we were there in mid-July. But now the ADX is down. It's getting down towards 15, breaking below 15. Now we're getting to the point where something is likely to happen sooner rather than later. And if it gets down to 13, then a breakout is likely imminent. And that's one of the things that we utilize in our volatility strategy at ewotrader.com, where we look for triangles, consolidation patterns, and we use that really low ADX to give us an idea of where or when the breakout is likely, sooner rather than later. And so one of our criteria, you could have a great triangle, but if we don't have a really low ADX, then we don't enter those. I just want to be really clear on this. I say it all the time, but again, for those of you that are new viewing and haven't heard me talk about triangles before, a stock can consolidate into a triangle and break out without a low ADX. But what also happens is you can form a triangle if the ADX is higher, and then you get a couple breakouts one way, the other way. And what ends up happening is it's just forming a larger triangle. It's not really making a breakout move. And then here comes the ADX lower. And if you'd gotten in sooner while the ADX was higher, now time decay is eating up your position if you were in a strangle the way we do with the triangles, and it eats away at the premium. So we do like a low ADX. So the fact that the ADX is breaking below 15, I don't think we're going to have to wait much longer. I don't think this is going to be a long sideways consolidation. We talked about the possibility on the SPY. I just don't think that that's going to play out. I don't think that's how things are. So let's look at the Qs, and we take a look at the Qs, and here we are. Also with the 10, 30, and 50-day moving averages all on top of each other. Now the Qs are below all of them except for the 30. So they're below the 10 and the 50, the two primary ones. As a reminder, the 30-day moving average I put on the charts, not because I think that's a major point of support or resistance, because I use it with the 10-30 crosses. A lot of institutions look at that. A 10-30 bullish cross means that they may look for an uptrend. A 10-30 bearish cross, they may be looking for a downtrend. So that's why that fuchsia colored line is on there. The 10-day moving average is your short-term directional indicator. The 50-day moving average is more of your longer-term, medium to longer-term trending indicator. And I know some of you are going to say, what about the 200-day moving average? Well, that's what the institutions look like for the really long-term. That's when you're talking about like Warren Buffett type long-term, et cetera. But when you're looking for more trending type of stuff, it's the 10, 30, and the 50 that we watch. So back below the 300 level, below the 10-day and the 50-day, but only one day. Yesterday we closed on top of it. So we're going to look to see tomorrow if there's follow through to the downside. I don't know that there's a whole lot really expected out of Meta. So I don't know that Meta is going to be a big market mover tomorrow, depending on what's said. But I don't know, we'll see. Let's look at the IWM. So the small caps, and we've been talking about this 170 to 190 level. And look at that, just going right smack dead in the middle at 180. That's crazy, isn't it? I mean, 170, 190, and then we're just consolidating right smack in the middle of it at 180. So which way do we go? Do we break back above 190? And does the trading range become 190 to 210? Do we break back down towards 170? And so we stay in this trading range. So right on top of the 10-day moving average. So that's the one market between the S&P, the Dow, and the Qs that is still on top of its 10-day moving average. So we'll see if we continue to go in this sideways range. You look down here, you might look at that and say, wow, what a great strangle that would be. It's not really a triangle, but it's going dead sideways right at 180. But see where that ADX is? It's not below 15 yet, but if that ADX had continued lower here and was down around 13, so way down in this area, even though you don't have that triangle view, the fact that you're going dead sideways right in the middle of support and resistance could have been an interesting looking strangle. But without the lower ADX, wouldn't want to venture into that. It's just more curiosity at this point. Which way are we going to go? Real tiny descending triangle here. I know Elliott, I talk about this a lot, always said, don't diss the small triangles, pay attention to the little ones as well. Everybody always wants to look at the big triangles, but don't forget the little ones. And it is a small descending triangle here, but the breakout is only, what, 5 points? So whichever way we break out this little triangle is not going to break above 190 or below 170. Likely it'll take more than that to break one of those major levels of support and resistance there, 170 and 190. All right, let's look at Bitcoin. Bitcoin had been doing well, and then heading back down. So it got turned away rather abruptly there at the 24,000 level. We had talked about this last week, and we'd also talked about this over the weekend, that if it could get meaningfully above 24,000, it would probably get to 28 really quick. And then that would be a point of interest, because we consolidated on top of 28,000 for so long on Bitcoin. And then we broke right through 24,000 like nothing, and then came down here to 20,000. All the levels that we talked about, the fours that we talked about, 28,000, 24,000, 20,000 on Bitcoin. Well, now we're back down towards that 20,000 level again, and back below the 10-day moving average. So are we going to break below that this time? There's been a lot of people that have been saying that Bitcoin probably moves down between 12 and 15,000. I don't really know where they're coming up with their numbers, but that's what some people have been saying on where they would find Bitcoin interesting. I just think that it's got to break 20,000 before you even start looking at anything lower, because it's held 20,000 just like it held 28 for a while, and then it broke down significantly. Is that going to happen again? We'll have to wait and see. But it's tried to break 20,000 a couple times, as you can see there, with no follow through. Every time it broke it, it immediately came back. So you got to break 20,000 with a follow through day before you can talk about anything lower, in my opinion. But it looks like we're going to test it. We're not that far away from it now, where we were just a few days ago talking about, can we get above 24,000? Can we break that level and run up to 28? And the answer has been a resounding no, can't do that. All right, before we get into some of the international markets, let's look at the VIX. And interesting here that although we had low volume on the downward move today, the VIX did move to the upside. And so it looked like we were going to continue lower on the VIX, like maybe we're going to come back down towards this 20 level and maybe have that be the catalyst to move the market back up to this wave 4, or at least test 420 on the S&P, but a little bit of a bounce back and back above the 10-day moving average on the VIX. So is that it? Is that move below it? As you can see, we traded above 25 on the high, but we closed below 25. And it's amazing to me, just absolutely amazing to me, that we're talking about 25 as some sort of support resistance level, but it has been since May. You can see that we were down here at 20 in April, March and April. 20,000 or 20 was the level here, and we broke above it. But since then, we first tested it in the beginning of May. It's been 25 has been the bottom. And I know I've said this numerous times, but I still shake my head on the fact that it is unbelievable the amount of volatility that's in the markets for this long. I challenge you to go back and find a period of time that has had this kind of elevated volume for this long. It doesn't exist, I'll tell you that. But look at this coming down here. Wouldn't you think that we would have had some sort of a massive rally here with the VIX making that big move to the downside here? So you can see all that move there. You would think you would have an equally strong move to the upside, and it's just not there. There's been a little bit of movement, but especially with today, we're back down here. So we haven't gone very far considering the VIX. So all this back and forth here has elevated volatility priced into it, which means options are higher priced. And a lot of questions have been coming in from people that have been trading calls and puts and being right on direction and being frustrated on the results. You get the direction right, but then the options don't make what they feel like they should. And that's because the options are overpriced when you get into them. Then they take the volatility out of them. And even though you're right on direction, they pull that volatility out and you don't realize the gain that you would think that you would that's the game that's played. That's what happens when you have higher volatility. So what's the solution? Well, you look for spreads. That's the idea, is you go ahead and play spreads, and you're going to see that we just did that on one of our case studies that I'll share with you in just a second. But let's look at a couple other international markets, and then we'll go there, and then I'll show those to you. There's the EWA, excuse me, that's EWZ. Well, we might as well look at Brazil real quick. We haven't looked at that one in a while. The wave 5 was 125%, and sitting down here, support at that level, trying to bounce. That's an odd level to bounce from. 138.2 would be a stronger level, but it is above the 10-day moving average, so you'd have to pay attention to that. But it is at a point now, you can see where there's resistance right from June. So if it can break above that and perhaps come up and test this 50-day moving average, maybe the Brazilian market can kind of go up and try to fill those gaps on its market the way the SPY has done and the Dow have done. Hasn't happened yet on Brazil. You have to be leery of the fact that it's bouncing from an odd spot at 125% extension, but nonetheless, it's at 2 days in a row above the 10-day moving average. So if you wanted to be doing something really super speculative, perhaps you could take a shot there. Now here's the AWA, Australia, and we got turned back at 22, but at least we got there. Held 21, which it really needed to do. It tried to break below it and head down to this wave 5 low, but so far we've been able to bounce back to the upside, kind of right at that 23.6%, a little bit higher than that. Wave 4, which Elliott was never really super comfortable with that as a full-on correction, more of a bounce within an impulse is the way he would view it. So that wave 4 could get labeled a little higher, but we're above the 10-day moving average, and the risk to the downside, we'd have to get back below that, and now we would have to break 21 meaningfully with a follow-through day. If we could do that, then maybe we come down here to this wave 5. But right now you're looking at, okay, we hit 22, we got turned back a little bit, but we were a little bit away from the 10-day moving average, so slightly overbought conditions, and we'll see if we can go up and fill these gaps here on some sort of a bullish move. Whether it needs the U.S. to do that or not, I don't know. Can it do it with the U.S. dollar gaining strength? I think that would be a little bit more of a concern than anything else. All right, so let's look at Canada, and you can see the Canadian market here. It did hold 33. We talked about that last week. Continue to do that. Went up to 34, and in our Thursday night insiders meeting that Zach was talking about, which is for our alert subscribers, we talked about how everything had bounced up to resistance. So all these things had gone up to resistance. What was going to happen? Were we going to break resistance and take off to the upside? Was the resistance going to turn us back down? Well, so far, resistance is held on all these charts that we've been looking at, and we're starting to move back to the downside, but without a lot of volume, so without a lot of conviction. So you don't put a lot of weight in that. When you see that, you're like, oh, okay, we've moved down a little bit, but it's not. I mean, look at this volume, nothing in Canada. So you look at that and you say, okay, well, the bounce was on no volume, so that doesn't count. Well, the consolidation is on no volume. The move down today, none of it really matters. So we're just kind of bouncing between 33 and 34, and you look at it and say none of that matters until some volume kicks in. So it's kind of odd there, the way that's playing out. Now, India, we take a look at the Indian market, and that one had been looking pretty good Thursday night. You can see that we held 39, which was really important. We got above 40. We ran all the way to test 41, which was the next major point. And lo and behold, India gets turned back as well. And we weren't that overbought from the 10-day moving average, a little bit, but not that much. And we closed back below the 10-day moving average. So is 41 going to be it? Is it going to hold this 38.2% wave 4 correction? Same exact correction that we have on the SPY in the US market, and head back down here? We'll see in the next couple of trading days if we can mount a run back towards that wave 4 or if that was it, we just had a little bit of a bounce here and we're heading lower. And then, as we always do, looking at Germany, the EWG, a lot of you like to look at Germany, and look at that, just turned back to the downside. And it just seems like we're destined to go down to 19 on the EWG. Even if we get a little bit more of a bounce, that's been the weakest of all the moves. We got a really, really weak bounce here, back up to test this level here at 23, and that was it. And we got turned back down. So I think that at some point in the not too distant future, probably before the end of the summer, you can see the tap box, time and price projection here on the software. By the way, if you're interested in the software program, it's called Profit Source. You can find out more about it at hubb.com. I think it's the best Elliott Wave software that exists out there. I've tried all the ones that I know exist. I think this is the best one, but this is showing you that sometime before the middle of September, we're likely going to see 19 on the EWG. All right, I did want to share with you that case study that I was talking about, and we did do this as a spread, and wow, we timed this one awfully well. So ORLY showed up on our impulse search, and you can see the entry here to get in was on June 18th, and there was the chart coming up here. And well, basically we were looking for it to continue its bounce up here and fill the gap. And even some of our subscribers said, well, what are we doing? It's in a wave 5 to the downside, wave 5 impulse to the downside, but we were at 76% here. So we were very close to disqualifying this Elliott wave pattern, and our confirming indicators, every one of them was telling us, hey, the likelihood is we will disqualify that pattern and go fill that gap. And so we took a shot at it. We did a spread again because of what's going on with the options, and look at that, boom, right up there. We got also within a whisker of filling the gap, but awfully close above the 10-day moving average. You get that close, you do what your trading plan was, which was to fill the gap. We generated over a 40% gain in just 3 days. And then take a look at this. We look at ORLY. We actually closed it out on the high. So since we closed that out, it's been down. So does it continue lower? Maybe, but that wave 4 did get disqualified, just as our confirming indicators said. So we take the Elliott wave pattern off. And how far down does it go? Who knows? We're below the 10-day moving average, but we don't always time them that well. But we actually close that off at the high of the move, but right at where our plan was, which was to fill that gap. All right, now let's look at those, by the way, are our alerts that we send out to our alert subscribers at ewotrader.com. That's different than these case study considerations that I'm going to share with you. For our alert subscribers, we send you out an entry, any adjustments, and exit signals, all through SMS and email. Here during TradeFinder, we look for case study considerations. You might want to look at this, and then you're left on your own to go from there. We have a few that would be considered open. We've had a pretty darn good success record if you've been following us on TradeFinder with these case study considerations. So RS was back on 5.3, and we have adjusted this one to the downside for our alert subscribers, and you already saw what's happened there. And so a little bit of a rollover back to the downside. So earnings are in the not too distant future there. HZO was one that we looked at here. We also sent this one out as an alert to the upside, looking pretty good. The problem is this doji here. What does that mean tomorrow? Just a really nice doji. And remember that a doji means indecision. A lot of people think that a doji means change of direction. Sometimes it does, but not always. But the classic definition, the real definition of a doji, is indecision. Now, that indecision sometimes does lead to a change in direction, or sometimes it leads into a big move in the same direction. There's no real way to know, but often when you see a doji like that, something happens the next trading day. So be watching to see, does this bounce again to the upside? If so, we'll probably take it off. or does it move lower? And maybe we need to take it off at that point as well. But we'll keep a close eye on that. And then MOS is another one that we adjusted to the downside for our alert subscribers as well. 524 back here. So it was set up like it was going to go higher. And then you can see what's happened. Rolling back over. 40 is our target. You can see the wave 5 is down there below 40, but we won't hang around that long. The XRT for retailers, you would expect that probably didn't have a very good day today, and no, it didn't. And so our entry was on 628 right here. So that was at 61.19, and today we were at 60.32. So profitable now on puts. How far down does it go? We'll keep an eye on that. But right now, it's sitting on a potential level of support. If it holds 60, then it could bounce. But if it breaks below that, then it's Katie bar the door to the downside. You can see that we're below the 10-day moving average, rolling to the downside. If the rest of those earnings reports come in negative, then watch out below. DG, Dollar General, looking for this one. This was back on July 5th. You can see there, and 250 looking towards 260. We haven't quite made it there. We're testing 240 now. So we want to keep an eye on that. It needs to hold this 50-day moving average, which it has so far. If it breaks below that, that one may be one that you say, okay, we'll just go ahead and close this off, take a small loss and move on. A test of the 50-day moving average is no big deal, but it needs to hold there. So the next trading day or two will tell a lot about that. And then MTH, Meritage Homes, and this was on the 12th. And just amazing, the home builders powering back to the upside. So that was at 81, and we got all the way up to 85. So not quite the 10% move we're looking for, but looking really good on that. Well, actually, in my notes, it says that we're looking for a move to 87. So we got that. So I wrote down 80. So we hit that. So we're going to take that one off. That's what we wrote down on the 12th, that we'd move up towards 87. We did do that. So we're going to go ahead and close that one off. Now let's see if we can find a case study consideration for tonight. And then we'll open it up to questions. So we have 4 stocks that are listed on the bullish side. Take-Two Interactive. That's interesting, isn't it? Do you remember when I was talking about monkeypox a while ago and I thought, is this going to be a thing? Well, apparently it's turning into one. Almost every state has cases of it now. Is that a big black swan? Interesting stuff. All right, so let's keep an eye on this. Not quite triggered yet on the DMI. For those of you that are new, haven't watched this before, that ADX has to break above 20. You want good separation between the two directional indicators. You want the ADX above the lower directional indicator. In this case would be the -1, as indicated by the red line, but it's got to break above 20, and it hasn't done that yet. So that would have been really interesting, I think, that with the resurgence of this new variant of COVID and the Omicron new variant, and then all this chatter in the background about monkeypox, et cetera. I don't know how significant that can get, but playing video games at home maybe could have gotten some interest. It seems like it has, but it's just not to the level where we would look at it yet. This is one probably shows up as much as Google. Google shows up the overwhelming majority of the time. The number one that people have asked me that before, what is the number one stock for Elliott wave that shows up? And it's Google. Google has more Elliott wave patterns than any other individual stock. Maybe because it's the most liquid stock or one of the most liquid stocks out there. But that's number one from my experience. And if we take a look here, moving up nicely, also haven't quite, boy, that looks really good, doesn't it? And our subscribers that have been with us for a while know that you've seen this before, where the ADX looks great and you're thinking it's going to cross 20 tomorrow. Just go ahead and put it on. Everybody knows to wait, because you can see that come up like that, look like it's going to hit it, and then it rolls over and falls to the downside. So you don't jump the gun. You don't get in ahead of time. Let it actually show its signal. And from right here, we have a pretty decent ascending triangle. It looks great. Like to send that one out, but simply can't do that without it being triggered. So we have two more to look at here. Jack Henry and Associate. Well, that one has a really good DMI. So maybe this will be our winner here. We take a look at this. And it's not an Elliott wave, 5-wave impulse pattern, so it's in a corrective phase. I don't think that's a qualifying zigzag. We'll look here. Almost. Well, that's an issue there, because with a 38.2% B correction, you're looking for a 61.8% extension on the C wave. And then if you go to an extended C, that's 100%. Well, we're already there too. But you look at the DMI and it looks like there's more to go here with the positive directional indicator ticking up, the negative ticking down. Could we go to 161.8? We also have this resistance here to worry about there. But we could likely move from, where are we, 200 to 205, probably testing those highs based on this move. But to break those highs, the DMI says that we could. Money flow is starting to wane a bit though, so that's a concern. Yeah, I don't know about that one. Maybe we get another 4 points out of it, but it's not looking very strong at this point in time. So that leaves us DCI, Donaldson, and also hasn't quite triggered yet. The ADX hasn't made it above 20. So none of those. You got to stay with your rules. So we got to stay disciplined here. We do have 89 stocks that are in corrective patterns. Let's see if there's any that are in a wave 3 and a corrective mode that we can look at. And Hub, but it's not HUPP.com, it's Hubble, is one that's consolidating in a wave 3. Was already broken out. It was consolidating, but it broke out. Well, now you see why we look at the triangles, right? Because you see that breakout move. This was an ascending triangle here with the same highs and higher lows. Move there. Yesterday would have been great. Today it's too late. So let's see if there's any that happen to be in a bearish wave 3. Probably not. There's usually, there is a couple. RH. Now that would be an interesting one for a downside move. Actually, I like that. So on a downside move, I don't look at the ADX as much because it's the ADX is a bit of a lagging indicator, and to the downside we move so quickly. But I do look at the directional indicators, so the red and the green line, and you can see the sellers have taken control there. And you can look at this and say, well, the home builders have been doing well, but this is coming back down. But at some point, the housing market is going to take a pause, right? I don't know. I think that one's pretty interesting. So let's take a look at that for potential downside move. That's borderline speculative. We do have a speculative portfolio at ewotrader.com when we have stocks that don't really come from one of our searches, and then our subscribers know that, hey, it's a speculative one. If you want to do it, if you have excess cash, you want to do it, great. If not, understand that it's fine because it didn't come from one of our 3 primary portfolio search criteria that we share. So that would fall under this category, be a little bit more of a speculative one for potential downside move, but I actually really like it. I think we probably break that 240 level and test down lower. Let's see what happens. So, all right, with that, Zach, I'll open it up. We'll take a few questions here with what time we have left.
Yeah, sounds great. As always, thanks for that presentation, Rob. It was very interesting. We have tons of great questions and comments coming in from the multiple platforms in our Zoom audience. We'll start out first with a question here from Ace from YouTube, saying that all the leverage play in the bottom has already been triggered due to all these other companies being wiped out. I'd love to hear your thoughts on that.
Boy, a lot of them have been wiped out. You are not kidding. And a lot of high leverage institutions have been, I haven't seen anything. I mean, even COVID didn't create this kind of wipeout. There's been nothing like this since the great financial crisis, as far as institutions, mutual funds, lots of hedge funds, obviously crypto funds. There's been an unbelievable amount of wealth wiped out in this last 6 months to a year. So has it wiped out enough leverage? I'm not sure. I think we're going to find out. I don't know if I can fully go there yet. I think we'll find out. We get past this week and see what happens. We might take another meeting or two from the Federal Reserve to see exactly how far the leverage move is gone, but it's a really valid question and valid point. I just don't know if we fully have the answer yet, but you're right. There's been an amazing amount of wealth wiped out in a relatively short period of time in this period that I've been focusing on, of such high volatility, and the whipsaws are just killing people. Big moves up, big moves down. People getting caught on the wrong side. We've been kind of quiet. I know it's probably frustrating for our subscribers that we haven't sent out more alerts, but sometimes it's best just to keep the powder dry until things settle down a little bit. We've picking and chosen a few spots like the ORLY that I showed you, and they've been kind of quick ins and quick outs, because if you try to trade anything on a trend, you just get so whipsawed now. It's almost impossible. Really interesting question and point. I just don't know that we fully have the answer yet. I would say ask that again in a few weeks.
Absolutely. Yeah, these are quite severe conditions we're experiencing. And from the bit that I've known, I know that most would say the state of their system, and to not try to trade off of guessing and, just hoping to catch a trend, as you were saying there. So we'll definitely find out more as time goes on. Next up, we have a really interesting question from Randall here on Zoom. Could the government be manipulating the bond market to keep rates down due to the massive debt they are paying on?
I'm not one to pass up a good conspiracy theory. Anyone who's heard me speak knows that, especially when we start talking about the Federal Reserve. But I always used to talk about, when I would do my soapbox speech on the Federal Reserve, I would always say, is it a conspiracy theory if it's based on fact? So, because I know an awful lot of facts about the Federal Reserve that a lot of people think are just on the conspiracy side of things. But so with the amount of debt that we have, certainly you would have to at least consider the idea that the bond market is being manipulated in some way. I don't know how the government could do that without the Federal Reserve. The Federal Reserve would have to be involved somehow. And unless they're lying to us, and they're not, which I wouldn't put that past them either. But if they are shrinking their balance sheet, which they say they are, that should be moving bonds to the upside, interest rates to the upside, not bonds, interest rates to the upside, prices lower, rates higher. That's what should happen when you're shrinking the balance sheet. So if they're raising rates and shrinking their balance sheet, and we know that international money has kind of dried up, how in the world are rates going down? So someone coming up with that, is it being manipulated? You have to at least consider that, even if you're someone that's not a big believer in conspiracy theories. That's, you know, the thing that's the most confusing right now. Why is that occurring? So is the Federal Reserve actually reducing their balance sheet? Are they just telling us that to try to talk down inflation? They are raising rates. They're physically doing that. We know that. But if they're raising rates and they aren't withdrawing liquidity, that's not nearly the double whammy that they said they were going to put on the economy. So if they're raising rates but not reducing their balance sheet, or even potentially still picking and choosing some spots to maybe buy some bonds and treasuries so that we don't feel the full weight of the 75 basis point rate hike, and it's more of a glorified talking point than actuality, it would actually make some sense with what's gone on in the bond market. But you would have to buy into the fact that they're not doing what they told us they were doing. So if you can go there, then yeah, I think that has to be a consideration. And it certainly would be an explanation of what's going on. So I don't want to say that's what's happening, but I'm saying that the consideration of that has merit. I'll leave it at that.
Yeah, no, well said. I mean, there's no question that, there's no way to know in fact, but it's certainly a very interesting question and insight there.
Yeah, I didn't mean to interrupt you, Zach, but we're getting some really cool comments and considerations here on these questions.
Yeah, no question there.
I mean, there was a time, I've been doing this for a very long time, and I used to do live seminars, and people, when I would start talking about the Federal Reserve, would just look at you with glassy eyes, like, what in the world are you talking about? They had no idea. Obviously, listening to the kind of questions that are coming up now, the audiences is it the internet or whatever? I don't know, or people are more engaged now, but far more on top of things, in the know type of questions and commentary that comes up now. I'm not saying that people are smarter now than they were before. I'm just saying people are more in tune to what's really going on in the world than they were before. People back then were smart too. They just weren't aware.
Right. There's more resources to utilize now and more knowledge to claim.
Yeah.
All right. So we'll move over to YouTube here with the time that we have left. There's two questions here from NerdRX and Luis saying that the TNX 10-year looks like there's a head and shoulders.
Let's see. Yeah, I wouldn't. It's not the greatest looking one, but is it technically one? Yeah. And the reason I say that is normally when you have a really classic one, you can see just that real kind of V and inverted V shape there that we have on the left shoulder, and we have the same thing on the head. And normally you would get that on the right shoulder as well, and it's kind of more of, little leveled off there. Let me turn that on. You can see that it kind of goes sideways here a little bit and then straight down. So it's a bit more of a rounded right shoulder. So it's not the most classic head and shoulders I've seen, but I would give you that that's a head and shoulders. If we break that, I'm going to be blown away. For those of you that are not sure how a head and shoulders works, that red line that I drew, that's called the neckline. So over here, that's the left shoulder, that's the head, that's the right shoulder. So what normally happens in a head and shoulders pattern, if we break the neckline, then the downward move is normally the same amount price-wise as the distance from the neckline to the top of the head. So if we were to go from, say, 27, that's 8 points. So if we were to break this head and shoulders and go down, we go all the way back down to 19 on the 10-year, under 2%. That's horrific for the economy. So if that happens, I don't even want to really think about what we would be going through economically. So is the head and shoulders pattern? Yeah, I guess technically it is. I hope it doesn't come to fruition then, because that would be really bad.
Yeah,
Unless,
yes,
you
it
know,
would.
unless the Federal Reserve starts, I mean, they would have to literally start cutting rates like next month, and they're not going to do that. So I don't know. I don't see the scenario where that head and shoulders plays out, but if it does, it's not good.
Yeah, that is for certain. So we'll have to see with that one. There are still questions coming through on all the platforms. So we're 2 minutes after the hour. So as always, I'm happy to stay on as long as you are. You tell me when.
Yeah, let's do two more. I chatted a little bit long there, so let's take two more.
Yeah, no worries. So from Zoom, we have a question here from Constantine saying the Elliott oscillator seems to confirm the wave 5 on the SPY, but not the DIA. What's your opinion there? I know you looked at the DIA a bit earlier.
Yeah, so let's look at them both. So the SPY with the oscillator. Yeah. So we kind of rolled over here on the SPY. I haven't totally rolled over on the oscillator yet. On the diamonds, I would say the oscillator is pretty similar on both. I think this plays into the fact that the downward move has been on basically no volume. And if we go through a couple more days like Meta, again, I just don't think that's enough to really move the market. I could be totally wrong on that. But then we go through, if we have a negative Amazon and a negative Apple, I think you're going to see some volume come into the downside. So I don't know. They're a little bit, I would say that there's more divergence there than confirmation, a little bit of a move to the downside where the oscillator is still moving up. And I think that plays into the low volume, which could suggest that maybe we just have a little bit of a tick down here and then we move higher. But man, we got to get the bond market on step with that if we're going to see any sort of a significant move to the upside in the market. All right, one more.
All right, so we'll do one more. I am going to work in a two-part question here just because I think it's a very interesting one. And you kind of talked about it a bit when you were mentioning the possible black swan with monkeypox. So JJ from YouTube says, what will likely be the catalyst for a big move up or down soon? I doubt it will be Facebook, Meta, a surprise, 1% interest rate hike, war expansion, hope not. So I know you kind of mentioned that it could be this possible monkeypox, pandemic in quotations that we might be seeing come about, and just wanted to hear your thoughts on what other factors, external factors might be out there for that. And then I'm going to give you one more symbol to end on.
Okay. Yeah. I think 100 basis points might shock the market a little bit because there was a time it got up to the highest I saw was a 28% chance of 100 basis points, but it's back way off of that. So if that were to come out, I think that could be a shock. I don't think whatever Meta says is going to shock the market. So I totally agree on that. I think 100 basis point rate hike might be a little shocking to the market at this point in time. So the question of what could there be a black swan? Right now, monkeypox seems to be in a specific set of circumstances. If that were to branch out, I don't fully know enough about it. I know that there's a specific vaccine that they've come up with for it, but then you also hear that the smallpox vaccine works against monkeypox. Does that mean people that have been vaccinated for smallpox can't get monkeypox? I don't know enough about it other than the fact that it seemed like some novelty thing. But now, like every state in the country has cases, and it's really running wild in Europe. So if it was to occur like that here, yeah, you'd have to wonder it doesn't have the fatality rates though. So even if it were to be some sort of a big deal, it's not airborne. So I don't think there's any economic shutdown. So I don't really think, I think monkeypox is more of an interesting discussion piece rather than any sort of a thing that could have a significant effect on the economy, even if there was a further outbreak in the US, because it's not airborne. The fatality rate has only been in Africa and nowhere else. So I don't think that scares the market that much. It's just a couple of weeks of discomfort from what I understand. So I don't think that's a big deal. I think it's got to be the earnings season. Once we get past earnings and everybody digests them, and the Federal Reserve does their 75 this meeting and then gives us some clue of what they're looking at from there. I think the market's just kind of waiting to see how deep is this recession. Maybe the GDP report is the key. If it really is a shallow recession, perhaps we sprint to the upside. If it looks really, really ugly, which I think it could look worse than expected, that could be what sends us down. I think there's more evidence that it could be the GDP report than anything else. I don't think anything in the earnings could say would be a surprise. I don't think the Federal Reserve, unless they win 100 basis points, is going to be a surprise. So that's really the only thing. A worse than expected GDP report or a much better than expected GDP report seems to be the catalyst to move the markets from here. Okay, what was the next signal or symbol?
Yeah, and I was just going to say there's also lots of speculation about the Taiwan invasion possibly being the next Black Swan too.
Well, that was we already covered that. So that was a Black Swan that we highlighted back. We said that war. Remember when people, I think it was on TradeFinder, it may have been the insiders meeting, but somebody asked what could be a Black Swan for 20, coming into this year way back. And the answer said was war, whether or not it was Russia invading Ukraine, which hadn't happened yet. And then, or potentially China and Taiwan. So one of them's happened. So, now that's very valid. If China doesn't go after Taiwan, that'll shock the markets big time. You can count on that. That's a given.
Absolutely. All right, Rob, thanks for the extra time here. We'll finish on this last one. Marcus from YouTube would like to look at Apple.
Okay, we'll look at it, but everything's going to change on Thursday. We ran up and hit that high at 155. Pretty much everybody knew there was going to be resistance there. That was the key. We talked about it needed to get above that level, and it couldn't do it. So it ran right up there to 155 and then turned back down. It's in a really classic 5-wave impulse pattern to the downside. Most of the speculation has been as far as Apple, because we know how much cash they have. We know that the Mac heads love Apple. The issue is going to be supply chain issues, right? Have they been experiencing them to the point where it makes a significant impact on their sales? It's really the only thing that could make a significant move lower. As far as the upside, if they were to surprise to the upside, it's still got to get back above 155 with a follow-through day. So everything's going to, I don't think you see much happen with Apple at all tomorrow. Everything's going to be resting on the earnings report on Thursday to see whether or not we continue down in that 5-wave impulse pattern or not. But, that's where things are with Apple. It's going to be all about supply chain. I still think that there's probably some massive disappointment that they're not more innovative on new products like they used to be. But Steve Jobs was a rare and unusual individual. So they don't come along very often, that kind of a visionary. Anyway, thanks everybody. As you know, always sign off the same way, and very sincere, very passionate about this. Time is the most valuable asset we all have, and we very much appreciate it when you spend some of your valuable time with us. And in turn, we try to make that use of your time as informative and educational as possible. Hope you found that tonight. Thanks again for viewing all those different social media outlet services. Thanks, everybody. Look forward to talking to you again next week. Take care, everybody.